Marc, welcome back.
Thanks for having me again, Owen.
It's always good to chat, mate. Always good to chat. I'd like to start this conversation off in a very different way. And I would like you to be brutally honest, if you must. Be brutal, that's fine. You follow what's happening in the Australian ETF landscape, in who's who in the zoo. You know exactly what's happening in more detail than anyone I know. And I know that you follow what we do. So I am curious, if you've looked at our portfolios at Rask, what your critiques would be.
I love this question, to be honest. I look at portfolios a lot. When I was back at StockSpot, we always did independent reviews of portfolios. Even now, a lot of clients coming to us with different portfolios. So I love this type of stuff. And, I've been a big advocate of your business and what you're trying to do. And to be honest, I was looking at the portfolios because I've been following you and your community for a long time. There's not much, to be honest. And I like going into the nitty gritty of some things. And there's a couple points I will raise, but I like the philosophy around keeping your costs low, investing in broad-based, diversified ETFs, using them instead of other investment vehicles as well, and having a very structured approach to rebalancing and your overall asset allocation. The two contentions I probably would have, because I like how there's exposure to, like, you've got the US market focus, you've got your fixed income focus, but the two I would say, and we'll get into in this topic, is just around the other types of defensive assets out there. One being gold. Would love to see that in the portfolios. And I know we'll probably have a good chat about the merits of adding gold to your portfolios. But I've seen a lot of managers allocate a bit of their fixed income exposure to gold because it trades like a zero coupon bond anyway. And there's a lot of diversification benefits to have in a portfolio by adding gold. So that would be the one critique. And probably the other one is I know that there's a bit more of I think it's a Martian portfolio, which is a bit more income focused. And I know that there's a couple of ETFs out there that play certain income areas. I guess the advantage, and I'm not tooting my own horn too much over here, but the good thing about our fund, which is ZYAU, is it does have a bit of it makes sure that the fund doesn't have any large sector positions that varies away from the benchmark. So if you are taking certain sector tilts based on going into a high yield product, just be wary of that. So those would be the two things. And then if you are looking to add a bit more other types of fixed income exposure, whether it be floating rate notes or whether it be subordinated debt, you could look at a bit more of a diversified banking credit product. But besides that, Owen, I think you've got the nuts and bolt nailed pretty well. Well,
thank you, sir. And for people's benefit, obviously Marc and I get to chat a bit and it's great, but I do just send you like a bunch of, and I do apologize about that, but I send you some, like, I have these, like, let's call them somewhat educated brain farts about, hey, what do you think of this idea? And you're like, well, maybe this thing. And I really appreciate you as a sounding board. I know your experience with StockSpot and obviously here at Global X is like significant, and you've got a depth of knowledge that is really, really special in this industry, mate. So not to butter your bread too much, but it goes both ways. Yeah, interestingly, like we will talk at length about gold today. Interestingly, so for ZYAU, for people that aren't familiar, this is the Global X S&P ASX 200 High Dividend ETF. I did a video on this yesterday, just standing in Martin Place, actually. This ETF that we obviously didn't, I didn't even think that you'd bring this ETF up, but I'm glad you did. So this ETF controls for sector exposures?
Yes, it does. It makes sure that it doesn't deviate in terms of having a 10% absolute weight from, let's say, the financials make up 30% of the broader index. This will make sure it doesn't go above 40% or below 20%. So it kind of neutralizes the sector positioning, which is quite handy for people who want to maintain a bit more of a tighter tracking error to the broader ASX 200. Otherwise, it might just own all materials and all financials. And that's maybe not exactly what you want within a high dividend yielding portfolio. If you are chasing yield, of course, like maybe you do want that, but sometimes you may want to control for yield. You may want to apply a bit more of a forward-looking dividend yield approach. Or you might want to apply a bit more of a filter that kind of removes companies that have experienced negative price declines. So that's what this ETF does those three things, and it makes it a pretty good value proposition for people looking to build some income in their portfolios, yielding around about 5.5% at the moment. So with the ASX 200 dividend yield falling to some of the lowest it's been in a few years, could be interesting for people to add just a bit of income. We're recording this. We'll soon see what happens with an RBA rate decision, what that means for other asset classes. So for investors looking at income, ZYAU could be quite interesting.
Management fee of 0.24% or 24 basis points if you're in finance lingo. This recently had a slight tweak in the philosophy, didn't it?
Yeah, it was a few years ago. So one thing about ETFs is we're constantly, being part of the product and investment strategy team, we're reviewing ETFs, making sure the methodology works, making sure it's the right process as well. And one thing we wanted to do was just simplify the process a little bit more. And we wanted to have something that also had that tighter tracking area to the ASX 200. So yeah, we did tweak it a few years ago. Before was looking at other things like buybacks, free cash flow, but we just said it would make a lot more sense just to focus purely on the forward-looking dividend yield, apply some sector caps to it as well, and also have that price momentum filter as well. Yeah. So on the back of feedback from investors, we don't make changes very often, but if there is enough appetite and we see merit in it from an investment research perspective, we'll go ahead and do that, and we'll always notify investors if that's the case.
Yeah, for sure. No, the reason I bring that up is I remember because this happened just after I did this broad review of dividend ETFs, and I think I need to do it again because this ETF, I remember when the changes were made, I was surprised that it hadn't had more investor support. Like it's got 75 million invested now, 76, but it could have a lot more over the next couple of years.
Agreed. I agree. I think income's going to be a big focus over the next couple of years. Yeah,
interesting. Okay, I did not know about that. So, I did know about it, but I just needed that jolt. So thank you for that.
No problem.
So we are going to talk about gold, which is the other thing. Now, as you know, I've done some things in the past, which I regret. No, I'm serious. I have not allocated to gold, I allocated to gold and then I removed it because I thought interest rates are low, economic stability. Subsequently, fixed income securities, while being stable, have not delivered, and meanwhile gold has gone up 35%.
Yep.
So that has been very frustrating for me to watch. And I think it's because I was like a dyed-in-the-wool Buffett disciple. I was kind of like, doesn't pay income. Like the old Buffett line, which you would know, is something along the lines of people who bought gold all those years ago still have the same gold. Whereas he's like invested in Coca-Cola and all these things. So I was kind of like, well, businesses make economic sense. Where do I go wrong with that? Where does everyone go wrong with that view?
It's not necessarily that it's a wrong view. It does make sense. You want to own productive assets that generate cash flows that you can value, right? So when you run a basic dividend discount model or a basic cash flow model, you can see what something is worth, which is why for something that's still tangible like gold, it's quite hard to actually fundamentally value it because it's all about supply and demand. So I think a lot of investors who haven't allocated to gold, and you're not the only one, Owen, there's been a lot of super funds that don't allocate to gold. They see it as similar to you, an unproductive asset that doesn't generate any cash flow. It just sits there in a vault, does nothing. You pay storage costs, and you're kind of betting that the price is going to go up. Yeah. And we'll probably get into the debate about the whole growth versus defensive side of things. But for me, gold is very similar to what we were talking about before on the fixed income side. It does trade like a zero coupon bond. And importantly, why it has gone up, particularly over the last few years, is even though you were mentioning that rates were rising, which is naturally quite bad for gold, you do have other drivers of gold. And one of the biggest things that the reason gold's been going up a hell of a lot over the last couple of years is there's just been so much economic uncertainty. And when there is economic uncertainty, when there's inflationary pressures, you naturally get this massive interest or influx into an asset class like gold because it has a long-term history of preserving wealth over multiple market cycles. We're talking multiple decades over here. It's not like an infant asset class at all. And it's not just that, but you're getting a lot of central bank demand as well. And there's a great research, if your listeners want to look into it, that the World Gold Council do. It's called I think it's called GRAM. It's the gold, I don't know the exact acronym for it, but it pretty much looks at all the attribution of what goes into it. I think it's a gold attribution model and gold return attribution model, GRAM. And it goes through all these different factors on what is making up the gold price or why is gold moved? Is it around interest rates? Because the two biggest, drivers of gold prices are the US dollar and real rates. And we've actually seen the gold relationship broke with some of them because the US dollar's been rallying, gold's kept going up, and we've seen yields go up, gold's also been going up. And I'm not sure if you know, Owen, in terms of if I had to say to you, who is the central bank that has purchased the most amount of gold, who would you say it would be?
Well, I'm going to guess and say China.
China is normally up there. I think they were in their top 5. It was actually Poland. They were a central bank in Europe who want 20% of their reserves to be in gold. And you're seeing a lot of demand, particularly from emerging market countries who are worried about tariff wars, what it means for the US dollar, and they are building up their reserves. And that's been driving a lot of demand. So we've seen 3 successive years of central banks purchasing at least 1,000 tons every year, and they've been net buyers for 15 years. So back to your question, I don't think you necessarily got it wrong. I just think some of the drivers are very different. It's not just one thing or 2 things that contribute to gold. There's a range of different factors. And we've even seen some flows coming into ETFs. Gold ETFs had outflows in 2013. 2014, there was about 300 mil that came into gold ETFs in Australia. And now we're recording this at the start of the year. There's already been about 150 million gone into gold ETFs. So I think it could be another good year for gold. I mean, it is trading close to that 3,000 technical level, but there's still a lot of tailwinds behind the precious yellow metal.
Interesting. Yeah, this World Gold Council, you were right, the gram, but they have portfolio simulators, the return attribution model, gold valuations.
There's some really great tools there for investors who are not familiar with gold, how to incorporate it in a portfolio, and we'll talk about portfolio construction in a little bit, I'm sure. But yeah, really good resource. And we've got a lot of, being the biggest gold ETF in Australia, we've got a lot of conviction that more clients should be allocating towards gold, because I think most, as we talked about super funds before, we talked their obsession with illiquid assets like private assets, private equity, infrastructure, private credit. I think a lot can look at gold as a liquid alternative in their portfolio.
It's really interesting because I remember this was with Chris from StockSpot. We spoke years ago about how much gold could be in a portfolio and the role that it could play. And that was really, really interesting to me at the time. But I've got a question that came from the community similar to that in just a moment. So a lot of people are familiar with gold ETFs, but maybe you can make the case for like why ETFs. Like a lot of people still buy physical gold though, right?
Yeah, you can go up, we're recording this in Sydney, up to Martin Place to the local ABC Bullion and purchase physical gold if you want and store it yourself. Again, you have to deal with the issues around storage, insurance, having to pretty much log this bar of gold or whatever it is. But there still is demand for people who want to have physical coins, physical bars of gold. But I think a lot of people just want the convenience of an ETF wrapper, especially for those implementing in their portfolios. Imagine rebalancing with physical gold in a vault in your bed or under your bedroom or something like that. ETFs just make it so much easier. So even though you pay a fee for holding the gold through an ETF wrapper, I think it's a very small cost to pay for institutional grade custody, having the insurance as well, and making sure that it's done in a liquid wrapper. I think it's worth it. Yeah,
so it's tradable. Yeah. So this was a question from the audience. Obviously, we're only speaking generally here, of course. But this was a question about gold that we received not too long ago, which is from funny name, Deramith Dairy Quite Contrarian. That's their name, Marc. So they said, I have a question about gold. It seems a strong case can be made to classify it as a growth asset, and a strong case can be made to classify it as a defensive asset. And editor's note, obviously this is so, you can, that's how you would allocate to it. Like that depends on how much you put in at what part of your portfolio and so on. They go on to say, I'd love to hear your thoughts on where you think it sits and what role it should play in a portfolio. End question.
Great question. And I've had this argument before with a few people, and I can understand why people see it to sit in a growth asset because it doesn't pay an income. And we were talking before, Owen, how a lot of defensive assets do pay an income, whether it's cash, whether it's fixed income. But why people say it's a growth asset is because if you look at its volatility profile, as in the standard deviation of how much the prices actually move, it's actually sometimes higher than share markets. So a lot of people think, well, hang on, this is meant to be a defensive asset. It should have a low volatility profile. That doesn't make sense. And not just that, your only method of return is capital appreciation. Yeah. There's no income for it. So you're literally betting that the price will go up or down. So that's, I guess, the argument on why it should be considered a growth asset. But I am in the firm camp that it should be a defensive asset. And there's a couple of reasons why. One is when you want defensive assets in your portfolio, that's when, not to say all hell breaks loose, but that's where you want assets in your portfolio that correlate differently to normal growth assets like your equities. And gold has a long track record over multiple rolling periods of having close to a zero correlation with equities. So when equities go down, gold isn't impacted as much. If anything, people flock to gold when share markets experience a drawdown, and it acts as a bit of a cushion to help add a layer of protection to your portfolio. So that's one side of things. The other side, and I've mentioned it before, is it is very similar to a fixed income security that just doesn't pay any income. So it's like a zero coupon bond. It's got no risk of credit risk as well, unlike a normal bond, because it's backed pretty much by sovereigns as well. And it's tradable, and it's one of the most liquid investment asset classes out there, sometimes even more than certain equity markets as well. You've got to remember, a lot of the trading in gold is done, we talked about central banks, talked about big institutions. It's not everyday retail investors like you and me. So I'm in the firm camp that it is an uncorrelated asset class. It is a defensive asset class. You want it to be the worst performing asset class because it means most things are doing quite well. And I think that if you're looking at building a portfolio, let's say, it's just like a 70-30 split or something like that, or an 80-20, that 20%, part of it should be allocated towards your traditional defensive assets like fixed income, but a small part should be considered to be something in an alternative asset that has those defensive capabilities or those defensive properties like gold. It's not a popular view to have gold in your portfolio. Most people only allocate a couple of percent. I've seen as high as 15%, but I still think it sits in the defensive asset class bucket.
While we're on the topic then, that idea, so say if you had an 80-20 portfolio, 80% growth, 20% defensive, roughly how much of that would be a gold exposure?
So there's been a lot of research to work out what is the optimal allocation to gold, because what you're trying to do by adding gold to your portfolio, it's a liquid alternative, and you're looking at improving the risk-adjusted returns, right? So it's a fancy way of saying for every unit of risk you take, how can I improve the quality of my returns? And there's been some modeling that's done by the World Gold Council that we talked about before that have said that once you start getting to like that 12 to like 13 or 14%, you start seeing a bit of a diminishing risk-adjusted returns. So you don't see a lot of people allocate probably above that. I've seen a couple allocate close to 15%, but most like the idea of having 5% in the portfolio or closer to 10% in the portfolio. And usually, like I said, if you're doing an 80-20 portfolio, it's usually a fixed amount. So if that 20% that's in fixed income, it could be 5% allocation to gold and 15% to fixed income. A lot of people are talking about things like cryptocurrencies, and we can talk about that later on, but they tend to allocate probably low single digits to something like that, 1% to 2%, whereas gold, because of the track record that it has, there's been a lot of benefits that show if you have anywhere from probably 5 to 7 to as close to 10%, you can improve the quality of your returns. The correlation of it is different to other asset classes. So that's generally where we see people allocate to gold.
That's really interesting. So people will know that Global X doesn't just do gold. There's other metals and there's precious metals and things just in the universe of things that people could invest in. I once saw a fella, he brought in I think it was a pound of copper, and it was kind of like the size of like a 1 liter milk. It was like big versus like an ounce of gold or something like this. Like there are other things that people can invest in, right? Other metals, whether it's like in terms of is it Wire that invests in copper?
Copper miners,
yeah. Yeah, copper miners. So you're getting the shares of companies that mine copper, but then you can invest in the metals themselves, like the physical as well. What about those other, like why isn't, say, silver as popular as gold? And it's not just because of the Olympic podium and gold tends to come first and all that stuff, but like what is it about gold that's so much, that makes it a superior investment and allocation compared to silver?
It's really about wealth preservation at the end of the day. And when it comes to something like gold, which is a bit more of a defensive asset, it's not as cyclically tied to what's going on in the economy. Whereas when you think about some of the industrial applications of gold, and there are some, like gold is used in some industrial applications, it's used in things like technology and also as in building blocks of certain things. When you look at things like silver, it's a lot more tied towards the economic cycle of where things are, which is why it could be seen as a little bit more volatile or have a higher beta to the share market versus something like gold. But there are a range of different applications when it comes to it. And if you go to the local bullion, you can buy physical gold bars, but then you've also got physical silver. And a lot of people are saying silver is trading at a massive discount to where gold prices are, and there should be an equilibrium. But again, you're not getting that same demand in terms of jewelry, right?
Yeah.
A lot of people still favor towards gold. Central banks are not hoarding silver. And these asset classes have different drivers, and during certain share market regimes, they may perform in different sort of regimes in different areas. And one thing that people use for gold in their portfolio is as an inflation hedge. And it's got a very good track record of doing that versus some of the other precious metals as well. So you can invest in things like platinum, you can invest in things like palladium, but at the end of the day, or things like, even lithium. But again, it's tied to broader economic influences or broader industrial influences as opposed to the raw fundamentals. And that's some of the properties that gold have. So amongst our suite, gold is still the most popular physical commodity. People can kind of blend it and have multiple commodities if they are interested. You can invest in soft commodities as well, but it really depends. Are you trying to get exposure to the restart of what's happening on the economic cycle, or are you using it as a defensive hedge? And for most people, the defensive hedge to protect against currency debasement, risk of the US dollar, tariffs, Trump, etc., a lot of people go towards gold because it's just got that stability and it's got that track record of really being a wealth preservation tool over time.
Interesting. Circling back to the Polish central bank buying so much gold, Donald Tusk, who is the Prime Minister of Poland at the moment, maybe there's something to that whole gold purchase, because a lot of the geopolitical risk and these types of things just give rise to those types of things, right? So in terms of maybe, because you and I have been speaking a lot for probably like 6 months now off air about what it takes to put a gold ETF together, because it's not like, say, as simple as just like an ASX 200 ETF as far as I'm familiar with. So what does that actually take? Like, some people are still confused around how a gold ETF actually works. Like you say, it's like a liquid thing, but you also mentioned that you have to walk across the street and get the bar. And we're recording here in the Sydney CBD, and just over the other direction, there's the exchange building for the ASX, but you don't have to walk over there to get your shares. You know what I mean?
Exactly right.
So like, there's obviously a critical difference in how things work. So how does it actually work?
Yeah, it is a simple structure in that it is owning an underlying asset class that trades on exchange through the ETF wrapper. The difference with it is it's not like a company that's listed on the share market that has employees working for it. It doesn't have necessarily, you can see the market cap of gold every day, but it's not the same as a typical company. But when you're investing in a gold ETF, Owen, it works very similarly in terms of how you can actually buy and sell units. You've got these middlemen, which are called either market makers or authorized participants, which will pretty much buy and sell gold on behalf of the investor if there's enough demand to make a creation unit or a redemption unit in the ETF. And all that happens is, instead of exchanging, shares between investors, what there is gold is held in a vault. So we use JP Morgan as our custodian in London, and we've got our own little pile of gold in the actual vault. I haven't personally been in the vault, but I've heard it's awesome because there's all these little crates that are in there. And all that happens is, if certain buyers or sellers are moving or creating units in each of these ETFs, gold will literally be pretty much forklift from one pile to another, because most of the trading is done by these big institutions. So Global X has its own little pile of gold. Well, it's actually not that little. It's actually quite large because we've got one of the biggest gold ETFs in the world. But what will happen is gold will literally move from one to another. Right. So all you're doing is creating units or potentially redeeming units in this fund. And at the end of the day, the end investor has a physical entitlement to that gold. So we publish a list of all the gold bars we hold, it's allocated gold, and we actually have had some investors who want to take physical delivery of that gold. Again, I don't know why an investor would, because it's good in a wrapper, but to have that ability to say, if I need to redeem the gold and actually get it out of the vault into my backyard or whatever it is, you do have that ability. So gold
Which is crazy when you think about it.
Yeah, I don't get why people do it, but the optionality of having that is, I guess, an incentive. But it's a very simple structure in terms of how people are very familiar with an ETF, but instead of buying underlying companies, you're owning actual physical bullion, which differs towards gold miners, where you're actually buying equities within the structure.
I don't want to bring too much light to this, but there's a scene in Die Hard where they are in the gold vault. And when you said like the forklifts, they are obviously taking the gold from the vault, but they have to get the forklifts to move it because it's so heavy.
That's right.
And everyone has their own kind of like, it looks like a little prison with all the gold bars stored securely in there. It's just, it's fascinating the way that works.
It is, but it's been happening for centuries, and it's got this long history. And the fact that we talked about central banks wanting to hold it on their reserves, and we talked about Poland wanting to have 20% of their reserves to diversify away from the US dollar and also, kind of hedge against economic uncertainty. I think it's a fascinating market, and a lot of people probably don't look enough at some of these pretty much just, bars of gold that are just sitting there not doing anything, but they're incredibly, incredibly valuable. And the process behind it is quite phenomenal as well.
Yeah, wow. So, there are quite a few different gold ETFs on the ASX, and I'm going to single out two of them from GlobalX in just a sec. The GOLD, maybe that's how we should refer to it, just so we know whether it's we're talking about gold generally or just the GOLD ETF. But then there's GXLD, and this is the newer ETF. It's also lower cost. And this is the one that's really interesting to me. And obviously we've spoken before off air about it. For folks who aren't familiar, what is the fundamental difference? Like GOLD is by far the biggest gold ETF in Australia. And then you've got GXLD, which looks the same, but is cheaper. Like, how does that work?
Yeah, I almost describe GXLD as like the mini-me version of GOLD. Okay. So we were pioneers in the space before, GlobalX, the business was called ETF Securities, and we came out with the first gold ETF in the world, right? So it wasn't just the first in Australia, it was in the world, and this was in 2003. And when we structured it, it was structured as a company, right? It wasn't structured as a normal managed investment scheme like what most ETFs are done nowadays. And that's because it was quite unique in terms of the actual structure of it. And it became this big behemoth. It became so liquid. People wanted to model the exact same solution, the same wrap of it in other different countries. And it became so popular. And when we were looking at what was happening in the ETF industry, you started to see a lot of low-cost gold ETFs come to market. And the question I normally get on is, well, why couldn't you just lower the fee of gold down to something cheaper? But it's actually a little bit more complex than just saying, we need to actually change the fee, and that'll be that. Because it's technically structured as a company, we still have annual board meetings. I know it sounds very old school where, in this room, people will come in, shareholders of gold can actually come in, and there'd be an AGM. It's very similar like going to an AGM for a company, which is very different. And that's not how a lot of the contemporary products are launched. So to change it would have been a huge administrative burden, and it would have been quite cumbersome to do. So we thought, look, for people who want the liquidity and the trust, and when you're looking at like the bid-ask spreads of something so tight like the largest gold ETF in Australia, GOLD still serves that purpose. But for people who maybe are looking to just buy and hold or dollar cost average their way into a low-cost gold ETF, GXLD doesn't have that same liquidity profile as gold. But if you're not looking at trading in and out every single day, maybe having 15 basis points instead of 40 makes a lot of sense. And we did see some rotation out of gold into GXLD for people who are wanting to get access to low-cost gold. But there's still a lot of people who value having gold because of the liquidity, because of the low trading costs as well. So it really depends on your time horizon, but we like offering both options to clients. Either your very traditional low-cost gold as a long-term holding, or something that can be pretty much favored for its liquidity, and maybe if it's a bit more of a tactical side of things.
Just to confirm for folks that maybe are as confused as I am, when you're saying liquidity of GOLD, what do you mean? Do you mean the bid-ask spread?
Exactly. So when you're looking at liquidity, I guess there's two layers of liquidity. One is the liquidity of the underlying. So gold, extremely liquid. Don't have to worry about it. It trades a hell of a lot more than some shares actually do. But when we're talking about secondary market, so Owen, if you were on screen, you're on your investment app and you're looking at buying gold, if you're seeing that the unit price is at $10, but the buy and sell is at 10.05 or 10.06 or a little bit lower than that, that's the spread we're talking about. And just in terms of the volume that's traded every single day, the GOLD fund has a lot more activity. So if you're looking to do a large amount of orders, you can always call our desk and get the market maker to make a price for it. But some people value that liquidity. They value having those tighter spreads because they are doing a lot of transactions. So we're talking about the difference between the buy and sell price, because you're not always going to get the price at the net asset value of the ETF. Yep. And then you're talking about how much volume or how much turnover is going through the ETF on the secondary market, which is on exchange.
Okay. It all makes sense. You mentioned something there, just call our desk. Mm-hmm. What are we talking? How much would you need to call the desk in order to get a separate quote?
So it's not something where if you're trying to trade, we've had some clients who are trading like a few $100s and they're like, I want a tighter spread. These market makers that are there to provide the facility of buying and selling, they need to make money as well at the end of the day. Yeah, for sure they do. So they make the arbitrage between holding the inventory and actually the difference between the buy and the sell. So normally if people are looking to trade hundreds of thousands or millions of dollars and they're not very happy with what they're seeing on screen, that's where you can call our desk. We've got a portfolio management team. They can have a conversation with the market makers who can potentially tighten some of those spreads. And we see it for a lot of clients who are interested in placing large orders. They don't want to impact the market. Let's say it's a bit more of a smaller fund or something where the actual volume that you're trying to buy in the trade is actually a lot higher than the historical average turnover. They just don't want to be caught out on paying something where they get a bad price or unfavorable price. So we'll call up the market maker, say, look, we've got a client who's interested in purchasing 5 million units of ZYAU as an example. They're looking at having a tighter spread. What can you do? And normally they'll see something on screen when you're looking at the actual sell side. The units will then pop up, and that makes it a lot easier for the buyer who's looking to do a large trade. But again, if it's something that's relatively small, that's not something that's in the market maker's best interest.
Yeah.
We're always trying to make sure the spreads are as tight as possible. We monitor it very, very closely. But yeah, when you're talking like single digits, it's very, very small.
Yeah. That's really interesting because like people will really appreciate that context around how you build a portfolio, Marc. So that's really interesting. I've got 2 final questions for you. One we've kind of talked about a little bit, but I'll get to that in a sec. The first one is like a few years ago, I think this was pre-COVID. I don't know exactly when this was. Buffett, people just take what he does and then think that he's changed his opinion or something. He actually did invest in gold, but he invests in a gold miner, which is different to investing in the actual gold itself. Can you explain to people the difference and what that implication would have for if they're wanting to get gold exposure, the different option there?
Yeah, I think it's important to paint some context in terms of how investors could get exposure to gold. One, we talked about getting access to the actual physical metal itself.
Yep.
But the other is through the share market by buying companies that are involved in gold exploration and gold mining. And historically, that is before the ETF came out, and if you didn't want to actually trade gold by buying it from an actual bullion dealer, most people bought equities. And a shout out to one of my coworkers, Justin Lin, who wrote a great piece called "Gold Investors: It's Time to Let Go of Gold Miners." He recently published it last week on our website. If anyone's interested,
yeah, can you send that to me?
Yeah, definitely. He showed that pretty much gold miners traded at quite a big premium before the first ETF launched in terms of their price to book. But as soon as the gold ETF launched, you start to see multiples really come down. And that's, I think, pretty much the market telling that, well, these companies were valued a little bit higher than what they were because that was one of the only reasons to get exposure to gold. But the gold ETF makes it a lot easier. And one of the reasons Buffett liked gold is because, at least gold miners, is it because it attracts, they generate cash flow, right? And sometimes they can be massively profitable businesses. A lot of people invest in gold in gold miners because it provides a bit more of a leveraged impact to gold. And you do see that sometimes it does have a higher beta or a higher sensitivity towards gold. But if you look at the performance data alone, they have structurally underperformed the physical gold price themselves. And that's because a lot of these companies, you have to deal with, in the business, we call it single stock risk or idiosyncratic risk. If one of these gold miners, for whatever reason, operationally, financially, they don't achieve their targets, they blow up, they have difficulties, their share prices will be punished, right? If they don't meet their earnings expectation, it will be punished. Whereas gold doesn't have that. They don't have the same earnings expectations. They don't have to manage a balance sheet or a cash flow statement. So for a lot of people who want exposure to the physical gold, particularly, and we talked about the correlations before, the correlations of physical gold to equities is a lot lower than gold mining stocks. So it depends. Are you using it as a diversifier or are you using it to generate income? So I see a lot of people and a lot of merit of using gold instead of gold miners. And historically, if you look, I think I was looking at the past 20 years, gold's done around about 9 or 10% per annum. Gold miners about 4% per annum. So quite a big difference when it comes to the performance.
And that's a significant sample size to look at it. Yeah. And it comes back to that, what do you see it as in your portfolio, right? As you said, like, is it a growth thing? Like Buffett was obviously buying, I think it was Barrick Gold.
Yep, that's right.
Barrick Gold, which is one of the biggest in the world. And that was the stock. Obviously, he's looking at the business fundamentals.
Yeah, because he was looking at it from a bottom-up perspective. But if you're looking top-down, maybe you don't have a view of which gold miner to buy. And there are gold miners ETFs out there. But for people who use it more as a macroeconomic hedge, we think that the far superior option would be physical bullion instead of gold miners. Yeah,
the proof's kind of in the pudding, isn't it? Okay, so I was writing down there that article, which I'll get from you and I'll include it in the show notes for this episode for anyone that wants to dive deeper, because like in the back of my mind, Marc, you mentioned all the big picture macro stuff about gold and like the kind of structural strengths behind it. Like it might not do 35% this year, let's be honest, but over the long term, there's a lot of good data around it. But the other thing is with interest rates falling down, it's expected to fall down. Actually, so we're recording this, it's now 2:13. So we'll have the data probably any second now of whether interest rates were cut. But with interest rates coming down, people are thinking, well, my bonds will eventually start yielding less. That's the way bonds work. So therefore, I'm going to start looking at these alternative buckets again. So that's where gold ETFs start to play a big role. So my final question is one that I've already asked you, but I just wanted to ask you again, because at the end of this, there's going to be a lot of people that are interested in thinking, like revisiting their asset allocation, myself included. You come across these instances of like all-weather portfolios. I don't know if it was Ray Dalio that kind of popularized that. It was? Yeah, okay. But a lot of people have this idea of an all-weather portfolio. There's different seasons for markets and so on, the analogy goes. But in a traditional portfolio, I've kind of asked you 80-20, but like take this whatever you want. Would you suggest that people consider the merits of, say, a 5% allocation to gold? Is that what you're saying?
Yeah, I think for a lot of clients or potential investors who want to build it into their portfolios, and most people, let's say, have your basic equities and your basic bonds, maybe they have something else on the side, this definitely fits in that defensive bucket that we spoke about before.
Yep.
And most people, at least they don't want to have a heavy weighting towards gold. I still think most Australians under-allocate to gold personally. And I mean, last year there were 40 all-time highs made within gold. And even now it's trading at an all-time high, and people are thinking, maybe I want to take some money off the table and maybe allocate low single digits. But I still feel like, let's say we cross that barrier of $3,000 a ton. I still think that gold can be the start of a secular bull market within gold. And for a lot of people, I think 5% is a really nice allocation to have. Again, this isn't recommended financial advice, but the merits of having that in terms of improving your risk-adjusted returns, which you spoke about before, even allocating up to 10% in the portfolio. And then what you can do is, let's say gold goes on an absolute tear, share markets crash, you can actually harvest some profit and allocate to the shares. So using gold as a strategic asset to rebalance makes a lot of sense in portfolios, because if not, that gold weighting, well, it starts at 5, if it does keep rallying, Owen, and I mean, I've got gold in my portfolio, I hope it does keep rallying, but I also hope everything else does well, that gold portion can start becoming 8, 12, 15, 20%, and therefore your overall risk appetite is actually changed in terms of how much risk are you actually taking. So really important, if you do have a 5 or 10% allocation towards gold, definitely have a rebalancing policy in place in terms of harvesting some profits. And as I mentioned before, you want gold to be a really bad performer. You really, really do, because it means everything else is doing well. But in an environment like this, where there's been positive correlations with equities and bonds, gold's also rallied because it's got different economic drivers. I still feel having that sweet spot, and that's where we see a lot of clients having around about a 5 or a 7% allocation towards gold. Okay,
I like it. Marc, always good to chat, and thank you for the critiques at the top of the show. I really appreciate that. I'll put links in the show notes to all the funds and ETFs that we mentioned and the literature you referenced as well. So I appreciate you taking the time out.
Pleasure. Thanks again for having me, Owen.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.